One day, 22%. The single worst day in stock market history. Worse than any day of 1929. Worse than any day of 2008. And here's what nobody can find when they go looking. The bad news. No war started. No bank failed. No recession began. The machine that crashed the market that Monday was built to protect the people it ruined. This is market memory, the mechanism under the most famous day Wall Street ever had. First, the climb. From the summer of 1982 to the summer of '87, the market roughly tripled, one of the great bull runs of the century. New money, new confidence, and a new kind of customer, the institutions. Pension funds and insurers now ran the market, and they had a new worry. Not missing the rally, losing the gains. And Wall Street had just started selling them a product that promised they never would. The product was called portfolio insurance, and the idea was beautiful. A computer watches your portfolio. When the market falls a little, the computer sells a little, futures contracts mostly, so if the fall continues, you're already partly out. The further it falls, the more it sells, automatically. No panic, no judgment, no phone call at 3 in the morning. By October '87, tens of billions of institutional dollars, an enormous share of the market for the time, were wired to sell on the way down. Each fund thought it had bought an exit. Nobody asked what happens when everyone's exit is the same door, triggered by the same signal, at the same time. The trigger week looked ordinary. A worse-than-expected trade deficit, a tax proposal that spooked deal stocks, interest rates creeping up. The Wednesday before, the market fell almost 4%. Then Thursday, then Friday, another 4.5%. Painful, but survivable, except for what it did inside the machines. A 10% slide in 3 days meant every portfolio insurance computer on Wall Street opened Monday morning with a backlog of selling it was already committed to do. The stampede was scheduled before the market even rang the bell. Monday, October 19th. The selling starts in Asia, rolls through London, and hits New York as a wall. The computers sell futures. Falling futures drag stocks. Falling stocks tell the computers to sell more futures. The loop feeds itself all day. 508 points, 22.6%. The worst single day in the market's history, then or since. Some stocks couldn't open for hours. There was no price at which buyers and automated sellers could meet. And the men on the floor learned the day's cruelest lesson. The insurance worked perfectly for each fund alone and ruinously for all of them together. Tuesday morning, the new Federal Reserve Chairman, Alan Greenspan, 10 weeks into the job, issued one sentence. The Fed affirmed its readiness to serve as a source of liquidity to support the economic and financial system. Translation: the money exists. Lend freely. Nobody solvent dies today. Banks kept lending to the dealers kept making markets, and the panic starved. Remember the shape of that sentence. You'll hear it again in 2008, and again in 2020. It's the same sentence every time. Only the machine that makes it necessary changes its name. Now the part almost nobody remembers. The recession everyone braced for never came. '88 was a growth year. The market was back at its pre-crash peak in under 2 years and finished '87, crash included, slightly up on the year. Sit with that. The worst day in market history inside a mildly positive year. The 22% wasn't a verdict on the economy. It was the sound of a badly built machine unwinding in a single afternoon. The owners who did nothing were made whole. The insured were the casualties. The exchanges built circuit breakers after that Monday. The market now pauses before a fall can feed on itself. But the deeper machine survives every reform, because it's not a product. It's a promise that you can own risk and have an automatic exit at the same time. 1987 called it portfolio insurance. 2008 called it hedged mortgage risk. Today, trillions follow rules that sell because prices fell. When you hear that a strategy removes risk automatically, ask who's standing on the other side of the door when everyone's rule says sell. That's what our live board watches for. The gauges are dated and the false alarms are published. That's market memory. Next episode, the bubble that took 34 years to come back. Japan, 1989, the biggest the world has ever seen. Follow so you don't miss it. And the full library with every source dated is at agenticsovereigncapital.com. This is education, not investment advice.